Hi, welcome. It's Mary Ellen McGonagle with your weekly Edge show for Friday, January 13th. Let's go ahead and take a look at what we're going to be covering today. As usual, we are going to take a look at where the markets closed in anticipation of what we can expect, certainly going into next week and beyond. From there, some of those headline news that drove price action, as well as critical reports that are going to be due out next week. And lastly, viewer question of the week. And this week it was all about how to capitalize on the current uptrend in the markets within growth areas. And I'm going to highlight two mega cap stocks that are on your watch list. From here, let's take a look at some of that news from last week. In the beginning of last week, we did see consumer credit continue to expand despite high inflation. That put a little bit of a dent in the markets, but as we progressed, San Francisco's Federal Reserve president talked about seeing interest rates this year rise above 5%, and that was another reason for stalling action in the beginning of this week. On Thursday, the much anticipated CPI, that's that consumer price index that is very reflective of where inflation is at this point in time and widely watched by the Federal Reserve. The report did come in below estimates, and the markets did begin rallying into that Thursday report in anticipation of a positive number. Also, we did see weekly employment report, and it did come in below estimates. And on Friday, January consumer confidence numbers were released, and they did jump to a 9-month high, again signaling that consumers are still spending. This was a boon to the retail and certainly consumer discretionary area, but I will share with you other drivers for that area as well. Last up, next week, you are going to want to pay attention to that producer price index, PPI report, another very critical report that the Federal Reserve uses for a gauge of inflation. Of course, we would want to see that number come in below estimates. And then retail sales and industrial production are also going to be reported next week. Now, let's go ahead and take a look. Where did the markets close for the week? And here we are with the daily price chart of the S&P 500. A couple of important areas to pay attention to. And first up is the fact that we closed just above this blue 200-day simple moving average. This is that last area of potential upside resistance, and ideally we want to see a continued move above this key area of potential resistance. We can see that we've had a couple of other rally attempts above that 200-day that did in fact fail. So of course, as we go into earnings season, that could in fact help be the driver to provide us with a continuation rally higher. Momentum is positive, that RSI above 50 and trending higher, and likewise with the stochastics. So as you can see, we are in the throes of a nice uptrend here. From my work, I am calling it a bear market rally. My MEM Edge report subscribers have been alerted to that. And then let's take a look here at the NASDAQ composite. And this was the top performer, up almost 5% for the week. And subsequent to that price action, we can see that the NASDAQ closed up above this red 50-day simple moving average. The momentum indicator is also in positive territory and trending higher for this index as well. Now, highlighted here is the fact that the week before last, we did experience what is called a follow-through day. This is a William O'Neill and Company methodology that has been used to signal every market bottom going back many years. Now, these market bottoms do not always evolve into long-term uptrends, as has been the case this year. It has been more of a signal of a bear market rally, which is being considered at this point in time. Nice positive momentum indicators that highlight the fact that the NASDAQ could easily trade higher, at least up to this 200-day simple moving average. From here, I do like to take a look beneath the markets. We want to get a good feel for where the strength is with these underlying 11 sectors in the S&P 500. And certainly the purpose here is so that you can capitalize on that strength. And then also this view, this 2-month daily price chart view, is very helpful in identifying sector rotation. So let's take a look at where we landed into the close this week. We can see that communication services, financials, basic materials, and industrials are up here exhibiting superior relative strength. And this is quite a shift, certainly from December when we had these more defensive utilities, healthcare, and staples that were up here at the forefront week after week. Interest in these stocks is waning as we see a move into newer areas. Financials, we did see a number of large money center banks report their earnings. While their numbers were good, the outlook among the management for these large bank stocks was not overly optimistic, but certainly enough to push those stocks higher. We can see the financial group is poised to break out of a nice 5-week base. So very constructive price action there. One of the better movers also up here in the forefront. Financials did underperform the broader markets, but basic materials really shine. They were up over 4%. That's XLB is the ticker symbol. And you can see this nice base breakout. Of note is the fact that this momentum, as noted by this black line up through the red on the MACD, is quite early in its potential advance higher. Your RSI positive and trending higher as well. Awful lot of this is due to the earlier than anticipated reopening of China, and China is the #1 importer of many of these metals stocks. And then other dynamics relating to supply demand issues are also pushing these material stocks higher. Next up here, we can take a look at industrials. Overall, it did not outperform the broader markets, but there are definite bright spots in here. Certainly airline stocks, among other transportation-related areas, and aerospace and defense. We can see, again, bullish dynamics just beginning to shape up. Subscribers to my MEM Edge report will be very aware of another bright spot area in industrials as we continue to add stocks to our suggested holdings list from this area. From here, let's go ahead and take a look at technology. Now, it is down in this lower quartile. However, this is a group that was also up almost 5%. We can see the nice advance taking shape here with XLK now above this 50-day simple moving average. MACD almost poised to trade above that net neutral. And this 200-day simple moving average is going to be rather critical. We can go back to this July into August rally and then the more recent into mid-December rally where that 200-day was a very ominous barrier to further upside. But for now, we are in a nice uptrend. In our next segment, I'll share with you one of the areas of strength within tech that did experience a downtrend reversal. Energy stocks on the move higher. Of note is the fact that this week it did break back above that 50-day, both momentum indicators positive, which now puts energy overall into an uptrend. There are definite bright spots and pockets of strength there as well. And again, take a look at that MEM Edge report and you'll be advised as to where they are and those stocks that can benefit. So from here, we are going to go ahead and take a look beyond these sectors underlying beneath even further in the markets. We want to get a deep dive and really get your arms around, again, where is that relative outperformance? 2-month daily price chart view using ETFs. So front and center here, I talked about basic materials, and here we are with a daily price chart of GLD, the S&P Gold Shares ETF, just really in a highly confirmed uptrend, certainly overbought with that RSI up above 70. I would look for any pullback as an entry, but clearly further potential upside in gold stocks. Small cap stocks big winners this week. We can see this significant move back above that 200-day simple moving average, outside momentum up here in positive territory. We like to see small cap stocks advance. When we are coming out of a bear market, small cap stocks do outperform, primarily because their growth prospects are improved. But at this point in time, last week's rally in small cap stocks was primarily the best performers were biotech and other healthcare companies that are coming through with nice clinical trial reports and potential FDA approval for their particular drugs. Now, from here, let's take a look at retail. I talked about consumer discretionary being on the move higher. We did see XRT up over 4% for the week. Nice breakup above that 200-day simple moving average. RSI and MACD in positive territory. A number of these stocks are up due not only to positive earnings reports that are beginning to trickle out, but also we can see that companies are reporting relatively strong December sales numbers, which is then trickling out beyond those companies where other stocks are also being lifted by that good news. Also, when looking at these underlying ETFs, let's take a look at the yield on that 10-year Treasury, because it did dip further. We're now down at about 3.5%. And a declining interest rate backdrop is constructive, certainly for growth stocks. So that is good news there. One last area to take a look at here is volatility. The VIX, also known as that fear index, and you can see it's now dipped down to the 18 level. Now, while that is good news, you can see that the uncertainty is beginning to be shed a little bit, and then also that fear. However, if we go back to these other periods when the volatility index got down into this lower area, 16 into 18, unfortunately, we did see a reversal in the markets where it did trend lower. So we will be keeping an eye on that. But for now, volatility remains muted. Now, there was viewer question of the week all about ways that you can capitalize on this bear market rally, and in particular, taking a look at growth stocks. So what I'm going to share with you now is a view of those mega cap growth stocks, and that will, of course, be Meta, Amazon, Apple, Netflix, Google, and Tesla. And what I want to do again is go ahead with this 2-month daily price chart view, add an RSI, sort the list in descending order, and I'm going to share with you 2 stocks in particular that stand out as poised to trade higher. First up is Netflix, and I will note that these 2 companies are both due to report their earnings next Thursday. But the good news here is, particularly with Netflix, analysts are revising their earnings estimates higher going into next week's report. We had several major Wall Street firms do that this week. And usually when these Wall Street analysts raise their estimates going into earnings, they're not going to do so unless they have some sort of insight that is guiding their estimates higher. And in the case of Netflix, there's a lot of positive talk about their program coming up, their ad-supported video on demand program. Once that gets started, they're expected that growth will come back to Netflix. And then also, Netflix has done a lot in the way of cost cutting and restructuring and in quelling sharing of passwords. So we can see that the stock has broken out of this nice 1-month base. And also your momentum is trending higher, that RSI trending higher above that 50. Likewise with that MACD having that black line up through the red, which signals a reversal of this recent downtrend into a nice uptrend. Now, ideally, I would like to see the stock pull back going into those Thursday earnings, because what we've seen historically is those companies that have rallied going into earnings, they're really going to be priced for perfection. So unless the numbers are super good, you may not see that push higher. The next name up here among these larger cap growth stocks is Amazon. And this particular stock really began its downtrend reversal this week on news of their Buy with Prime program that they've opened up to allow really any online retailer. It was prior to that only by invitation, so it really limited the capability for companies to participate that and continue to grow. So that was certainly viewed as very good news. And then also the climate for retailers has been improving as well. So let's take a look at the technicals here on the stock. It has broken back above this 50-day simple moving average. Nice high volume characteristics here as it continues its ascent. Your next area of possible upside resistance is going to be at this 200-day simple moving average at about the 116 level. What I like is that MACD just entering into positive territory with further upside certainly allowable or conceivable. And then also that RSI above 50 and trending higher. Of note is the fact that the company is due to report their earnings on Thursday as well. And analysts are citing the fact that Amazon, certainly relative to historical precedents for the stock, is cheap. We also experienced this nice base breakout today as the stock is rallying on nice high volume. That's it for this week, everyone. Enjoy the nice long weekend. And I'll be on the lookout for you again here next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.